And a very warm welcome to everybody. Thank you for joining us for the CareSuper market update. I would like to start today by acknowledging the traditional owners of the country throughout Australia, but in particular for us, it's the Wurundjeri people of the Kulin Nation, and pay respects to elders past, present, and obviously extend those respects to all Aboriginal and Torres Strait Islander peoples. A big thank you to all of the members that are online. We've had such a profound response to this, so it feels that people are quite keen to have a chat with our wonderful presenters today. So I will introduce them. We have Suzanne, who is our Chief Investment Officer, and we have Dan, who is our Head of Financial Planning. So they are the two most well-versed people to have a yarn with today. I think I would like to say, we do have, I think, over 1,000 people online. So we have made sure that you can ask questions, but please know that they will be going into the background here and be fed through to me, which is why I've got my laptop open. A lot of you did send in questions prior, so thank you for doing that. And we will be answering those and using those throughout the course of the session. It's pretty fair to say, and we've certainly been having these chats, the world is pretty noisy at the moment. It's from October last year when we're thinking about Trump and the tariffs, and then we've had talk about AI, we've got cost of living, we've got interest rate rises, and now most recently, obviously, what is very seriously happening in the Middle East and its impact not just on people there, but obviously on us, fuel prices, making sure how we adjust to that, but then how does that flow through to food prices? It's a cacophony of information at the moment, so we're going to help try and make sense of that for everybody. And that's what Suzanne is here to do. And we will get to markets in just a moment. But I wouldn't mind by just starting with you, Dan, and saying, you talk to members day in, day out. What is on their minds right now?
Yeah, what we're hearing currently is members are rightly concerned about cost of living. They're seeing fuel prices go up. They're seeing the cost of groceries go up. I think there's a large portion of our membership base who generally worried that there's going to be fuel so they can get to work. So that's a real concern in the short term. But if we think longer term, there's a lot of members who are starting to wonder, well, what does this mean for our ability to retire? If they've got a specific retirement date, does that mean that they might need to work a little bit longer if they still want to maintain that cost of living they had? Or potentially, if they're not flexible on their date, does that mean they have to reduce their expenses? So people are concerned what it means. I think we've had a few good years in the markets and people are wondering, is this just a blip or is this something more significant?
There's a lovely segue to you, Suzanne. It's hopefully going to help us make a bit more sense of that. What is happening? I mean, we live in a global world now, right? And we're at the influence of many things that happen overseas. Can you just talk about that for us?
Yeah, certainly I can. And understanding what's happening in markets, in share markets in particular at the moment, and the connection with the Middle East was, a key topic in the questions that we received. So clearly members are really interested in really unpacking that. Today I'm only going to focus on the Middle East in the context that it impacts our members' investments and investment markets. So just so everyone knows, I'm not going to go anywhere else with the information today. I know why everyone is here. The key thing to understand is how those events, though, are translating to an impact on investment markets and the investments that we have on behalf of our members. And the central thing within that is really what we're seeing in oil and the higher oil prices and the disruption to oil supply around the world. So, why is it that oil is such a key factor when it comes to share markets in particular? It's really how it translates, and it translates via inflation. And the concern in markets and amongst investors is about the impact on global inflation. So how does that work? Well, it's through petrol prices, which you mentioned, cost of living, but energy and oil is a key input to all global economies. So it's not just filling up at the petrol station, but it might be the need for energy in transporting food or running a shop. So this really does filter through to economies at large and to inflation as a whole. And there's two things that are really making a difference for markets and investors are focused on. One of them is time. So how long is supply disrupted for? Because time influences how much the inflation starts to permeate through economies. And also the other is the supply. And that's why we're seeing a lot of concentration on ships getting through the Strait of Hormuz and when supply is released from special reserves around the world. And that is because the time at which it takes for supply to restore makes a difference to financial markets as well.
Yeah, no, that's great. Thank you. And look, it's pretty fair to say, and markets are forward-looking beasts, right? We've got people sitting there trying to predict. They're not looking necessarily at always what has happened, but they're trying to factor in what is going to happen. And you talked about certainly time, how long does this go on for? Can you sort of unpack, for us, what are the big influences that move markets and what are they reacting to?
Yeah, sure, Kat. So inflation is a key thing. And you're right, markets are anticipating what might the consequences be. And it's absolutely correct, markets always do anticipate. Inflation, yes, but what are the other key influences? If we think about the events that are unfolding in the Middle East, there are a myriad of influences on, different countries that might have companies that might have operations there. But there's really three big forces that drive investment markets, share markets and fixed income markets. And that's inflation, which I talked about, and the impact that has. But it's also interest rates. And we know that inflation really has a big impact on what central banks do with interest rates. So it's a perception that interest rates won't be able to be lowered or might be higher than we otherwise would have thought. And also the third really major factor that drives investment markets is growth. And the sense is that the disruption, trade hub, transport, that will have a negative impact on growth as well.
Yeah, I think that your chatter just then about interest rates has certainly hit a nerve. We're getting some questions now about, we just saw interest rates go up on Tuesday.
Yeah.
We've had interest rates go down. We're now seeing them go up. I know you don't have a crystal ball. You might be on an island somewhere with all the money in the world if you did. But say you were to predict, what was your feeling about interest rates at this point?
Yeah, I absolutely. Let's talk about that. So, and I think that there is, when it comes to Australian interest rates and what the Reserve Bank has done, there's potentially a little bit of confusion about the intersection with that and what's happening in the Middle East. Those who participate in financial markets and watch and have expertise in anticipating what the Reserve Bank will do, had already thought before this conflict started that the Reserve Bank was likely to put interest rates up. Why was that? Well, it's because the economy was tracking a bit stronger than most had expected, but also Australian inflation was already high. So in December, we know that Australia's inflation rate was 3.8%, and the Reserve Bank is looking for 2 to 3. So there was already an expectation that past economic circumstances could warrant the Reserve Bank putting inflation up, and they certainly did that the other day to 4.1. Now, there is a sense as well that with what's happening in the Middle East and, this potential, somewhat upward pressure on inflation as a result isn't going to make their job any easier. So I think it's unlikely that anyone's expecting that they'll be able to put down rates quickly, just for now.
Okay. Unfortunately, because I know, like Dan, you said, cost of living is probably the number one thing on people's minds. Yes, definitely markets, what's going on, but cost of living and our ability to then, once we need the money in super or apart from the day-to-day, but when you get to your retirement age, how do I then turn this balance into something I can live on? I guess the other part that's really playing into at the moment, that if you log into your members online right now, you will see that balances have gone down. And that's for any fund.
Yeah.
We've had members asking, my balance has gone down. What do I do about what does that mean? What's your advice when we go through periods like this?
Look, to think about volatility and how we deal with markets like this, I think it's important to come back and explain one concept first. So when we think about investing from a financial planning perspective, there's a huge amount of complexity in what Suzanne's team do inside your account. But for the average person, that's going to happen, right? With a good fund, that's going to happen. But there are some decisions that you need to make that can help you manage volatility. So pretty much everything that we can invest into can fit into either being a growth asset or a defensive asset. Growth assets are generally made up of things like shares and property. Now, these are the things that can be affected by volatility. You'll see over time, you'll see graphs and you'll see it goes up and down and up and down. But over the long term, having exposure to growth assets, we expect that you will have a higher balance at the end. defensive assets perform very differently. These are, you could say, the cushion or the safer part of your portfolio. These are made of things like bonds and fixed interest and things like that generally. And what we tend to find with their returns, they tend to be a lot smoother. There's still risk, but they tend to be a lot smoother. But what you will find with these assets is your long-term return will likely be lower. So the real decision that people need to be thinking about is what allocation should you have in the markets and what should you have in those more defensive assets. And a way of working that out is to think about what's your investment time frame. Are you a short-term investor that you need those funds sooner? Maybe you might want to avoid volatility because of that. But when we think about our superannuation, it's a really long-term investment. So what a lot of people will try to do is to still have some exposure to growth assets, knowing that we're going to have some exposure to volatility to try and get that long-term return where we need it to.
So that's a really interesting one. So I've heard this one a number of times from members, right? So we know we're invested while we're sitting in an accumulation fund, and we pick our investment option. And the good news is, guys, people like Dan can definitely help you choose the right one for yourself. And it is a really personal choice. So it is up to you and how you feel about investing. But the thing that often comes up is, what happens when you get to retirement? Do you stop investing? Is it put it in cash? Like when you change from an accumulation account to an account where you can take your money out, what happens?
Yeah, it's a great point. A lot of people will think that when they actually get to retirement, that's where you take your money and you put it in cash and you just draw it. But if you think about it, your average person, let's say you retire at 65, life expectancy is mid-80s. So you potentially have 20 years that those funds need to be invested in. So if you hold those funds in defensive assets like cash, your long-term return is going to be lower. You will have less volatility, but what people will often need to do is they'll need to make their money last because it's got to go for so long. And because it is a long-term investment, you will likely still want to have some exposure to growth assets. But it's about balancing where you're at now. Your risk profile, your ability to tolerate risk will change over time. So it's still going to be invested and you still might need to have some exposure to risk.
And in essence, like if you're thinking about it, because if I'm a member and say I'm a week or a month or 6 months out from retirement now, I'm going, this couldn't be worse timed, right? Market volatility, I feel like I need to use this money now, and we'll come to lump sums versus income soon. But yeah, the truth of it is, and what I'm hearing from you is, when you retire, your money could still be invested for another 20, 30 years.
Exactly.
Luckily, if you're lucky, right? Yeah, it could be much longer than that. So I think the heart of it is, even though you might be retiring in the next month, the next week, I think it's really important to note that depending on how you choose to invest your money, you will be invested for a really long time still. So the money does have time to actually recover from whatever sort of we're seeing through these short-term events. Now, Suzanne, I mean, the question on everyone's mind probably is, I talk about it being a short-term event. Is it not? How much worse could this get?
Yeah, it's a really important point. And the short answer is it could. Markets could continue to face a bit more of a setback. That is a possibility. But I think some context is important. So I might provide some thoughts that might sort of set the scene in terms of what's happening now and what to expect. Firstly, though, I would like to say that whenever members see their balance go down, that's always concerning, and we understand that. So for all the context in the world, we kind of get what that feeling is like, and we're very mindful of members being concerned about that. But let's have a look at what's actually happened. We know that since the conflict in the Middle East began at the beginning of March, that share markets have come down a bit, and members have noticed that. If we look at the balanced option, just the balanced accumulation option for the moment, where it's a great example because it's similar across all options and it's where most of our members invest. Financial year to date, the balanced option is still up about 2.8%. So it is still higher than it was in June. It is a little bit below what we saw around Christmas, which was more like 4%. But I think that some of the headlines might paint a worse picture than that. And in actual fact, all of CareSuper's diversified options are up financial year to date, between about 2.5% and 4%, depending on the option. So I think it's really important to understand that, and to also remember that share markets and events experiencing volatility and often some change is a very normal part of investing. And we always talk about the merits of being a long-term investor and adhering to your strategy. It really is true. Even over the last 10 years, we saw markets take a dip in 2015 and 2018. There was a very significant downturn in share markets in COVID in 2020. Markets recovered very well from that and quite quickly. And we saw another period where there was volatility in 2022 when interest rates went up around the world and we had a period where there was inflation. But through all those periods, markets have recovered, the options have recovered, members' balances have recovered, and this really is a normal part of investing. So in context versus some of those past episodes, I think the fact that our options are higher financial year to date should give members some comfort. But yes, things can get worse. That is possible. We don't know exactly when supply in oil markets will be restored, when tensions will alleviate, when will it stop. But one thing that is very important that we do on behalf of members is we are not just focused on acting and navigating, making changes to portfolios, changes to asset allocations in response to this, and hopefully in anticipation, because we did take action quite early. But it's also about anticipating the opportunity, because when there is relief, when there is resolution, and that recovery commences, we need to be very mindful of taking advantage of opportunities for members as well. So we are always navigating both. And sometimes looking to that point of when there is recovery and what that looks like and where the opportunity will be is just as important as navigating the downturn well.
Now, and look, this one will feel like a Dorothy Dix, and yes, members, it is, but I think it actually is really important to talk about how does the CareSuper investment strategy differ to others? Because all markets, everybody who is invested now is going through this.
Yes, absolutely.
So no matter where you go, but different funds, different investments will go up and down at different rates. Why Care? Like, what do we do differently?
Yeah, it's true, Kate. And different funds do have different styles, and the performance varies in different sort of market environments. CareSuper has a very long-standing history of having an investment approach that is more risk control than some other funds. So what does that mean? We operate and have built our investment strategy. It's been successfully executed for over 25 years, and it's designed to navigate all sorts of different market environments, to deliver strong long-term returns, but in a way that navigates the bumps and bruises and really limits the downside when markets become difficult. So our investment strategy is specifically designed to cope well with these sorts of events, to mitigate drawdowns, to mitigate risk. It's sometimes members might see it referred to as a smooth ride, but that is definitely what we're aiming to deliver and what we have delivered in the past. We believe it's really important and beneficial for members to understand how we invest. And why do we do that? Well, I think what we're seeing at the moment illustrates the point of what we're trying to achieve. You want growth, but you also want to have that comfort and that security that we're protecting members' investments, and being able to protect them when things look difficult is really important to having that confidence in their retirement and not making the wrong decision at the wrong time. If you know that your investments have that resilience and that defensive quality, then that can help along the journey.
Yeah, and I think a lot of people do take a lot of comfort in that. It is a core to our strategy. We do, have options for people who do want to take a little bit more control. I mean, that is up to people, but I think it is times like now where people realise, gosh, I'm glad I've got a professional investment team who are looking at this day in and day out. I mean, at its heart, we're talking about what's going on in a market. It is a period of time. It's happened before. Markets will recover. We don't know when, but they will. They will actually recover. And that's, I've been in super now for 25 years. I feel like I say this every single time. And they do. That's the truth of it. But at its heart for a member, if I'm sitting here, this has to translate into income at some point, right? This is not just a balance that sits there. I want to use it for things. And if I'm honest, we talk about being invested in retirement, and that's really great if I'm only drawing down an income. But Dan, what if I'm someone, and we certainly had these questions come through beforehand, is what if I was planning to pay up my mortgage next month? What if I was going to take out that lump sum to do that trip that I've been planning forever, although travel is a little bit fraught at the moment, but I've got something planned and I need to take a big lump sum. That is different, right?
Yeah.
So explain that.
Yeah, there's a concept in investing, financial planning, that we call sequencing risk. And this is the risk of when you are selling an asset, what's the value of that? Because that could affect the outcome for you. So I'll give you an example. Let's say someone has their superannuation and in a year's time, they're wanting to draw some money out to pay down their mortgage. We see a lot of members who do this. If in a year's time, your super has gone up in value, right, that means when you actually sell those assets, you're going to have to sell less underlying assets because they're higher value. So that's a good outcome. If, on the other hand, the underlying value has gone down, that means for you to actually get enough funds to make that purchase or pay down that debt, whatever you're doing, you actually need to sell more assets. So that can mean if you're selling it in a period where the volatility is down, it can actually put you in a slightly worse position. So some people might choose to think about delaying their plans to draw funds out and make changes to their accounts until it picks up. There are other things that you can do around that. Our comprehensive financial planners can help you with strategies to reduce the volatility by matching out your growth defensive allocations. In some cases, we can even consider holding a portion of cash for those purchases. But again, this is getting very technical, but there are strategies that people can utilize to reduce the risk on that.
It's amazing. I think members online, I'm just reading it now, but the members are actually picking up on a really, really good point. Probably goes back to an old Warren Buffett adage, which is be fearful when others are greedy and greedy when others are fearful. And we're getting questions, right, saying, is now the time to put more money in? Either of you can answer that one.
Look, I'll take that and I'll say that if it comes down to your individual situation, if you've got funds, you've got to do something with it. So the fundamentals are the same, whether it's inside or outside super, you're still exposed to either having growth or defensive assets. The great benefit of having it inside super is there are massive tax incentives to do this for you. So it's not just about the markets. That's not the only consideration. You also need to think about your timing, what else is going on in your situation, your contribution caps, and what does that mean to your broader situation. So I'm not going to answer the question because it's hit as an individual one, but there's a lot that goes into it.
And I will use this wonderful opportunity to express to you that this is general advice only.
Yes.
Nothing we say obviously should be used for your personal circumstances. But if you do want personal advice, we have a plethora of humans who can definitely help you with answering those very specific questions. But Suzanne, you want to give it a crack?
I'll have a go. Yeah. I think you're right, Dan. That's the answer to that is highly individual. Okay. Some members might be really savvy with these things and be really okay with the ups and downs, and they might choose to add more money in down markets. And many members do that, and that usually works better than de-risking your investment when markets are already down. Yeah. You do run the risk, though, that if it continues to go on, that, you regret thinking, oh, gosh, I've put more, I've added to my share allocation, for example, or I've added to my growth allocation. But that's a highly individual thing. I think there's a small number of members that can do that well and have confidence in doing that. I think it is much better for members to have selected the right option for them in the long run. And to stick with it, to stick their investment strategy. It's generally accepted to be better to continually add to your investment in small amounts and gradually over time than be attempting to try and time markets.
Yes.
That really is why we're here, and they are the things that we are doing in the investment team and the investment program, assessing areas of overvaluation, assessing times of opportunities, weighing fundamentals, market execution, all of those things is what we're set up to do. But for members, I think it's much better for most members to stick to their investment strategy.
It seems like I'm good for a Warren Buffett quote today, but is it? It's time in the market, not timing in the market that does count. Although there are plenty of people that are online today that are still in accumulation phase and their employer is still contributing for them, and that's on a regular basis, whether weekly, fortnightly, monthly, quarterly, whatever the case might be. And it is true and fair to say that if you are putting money in and using really simple language, that you're buying stuff on sale, potentially. So you are getting potentially more value by putting money in. So please be rest assured that during periods of volatility, if you are still accumulating, it can actually work to your advantage. That's excellent. All right. So, Dan, Suzanne, based on the things that we've covered today, do you think we've missed anything? Is there any sort of comments, final thoughts that you would give to members?
I've got one. One of the pitfalls we see people take in markets like this is, like you said before, trying to time the market. Timing the market is one of the toughest things that we can do. We see a lot of members who we get some news that might seem bad. We're worried that markets are going to drop, and what they do is reactively change their investments into a cash option. And what that means is, or what tends to happen is, the information that we as lay people get is not as good as what Suzanne and her team get. So the average person will tend to hear about it after the markets have gone down, and they tend to go to cash after it's dropped. And then what they need to do is be able to time when they go back into growth assets before it recovers. And a lot of people miss that. So they tend to go to cash, crystallize their loss, and then they're still in cash, where what they would have been better doing is having their long-term plan, sticking to the fundamentals and not changing. And if you do that a couple of times throughout your lifetime, it can really, really affect the balance that you're going to have. So for most people, that strategy can put you in a worse position. So we try not to do that if we can avoid it.
Yeah, that's a really good point. And I know nearly every fund over that COVID period, and certainly in any other times of volatility, we'll see people reacting to what is a great deal of noise in the air, right? Look, let's face it, there's a lot out there that doesn't feel overly nice right now, and you're wondering what on earth's going on. And it can feel like a safe bet to put your money in cash. But all of us have been in this industry for a long time, and I think every single time you see the majority of members actually not picking the right time to come in. So they often will sell out. So markets are forward-looking mechanisms. They're actually already pricing in. By the time you hear it on the news, the markets have already tried to predict where it's gone. It's gone. So you're then putting it into cash probably at potentially the worst time to do it. So you're selling at the bottom. And then by the time the news cycle has moved on and people forget and they don't move back and become invested, or they're doing it at a point where markets have then risen, you've actually lost quite a significant portion of your money. So whilst it might feel like a really great thing to do, and it certainly can give you peace of mind that your money's no longer sort of going up and down and your balance stays as is, you could do yourself quite a great deal of detriment in the long run.
Yeah, and to avoid that, members can speak to our financial planners, and we can assess based off your personal situation, what is your actual investment time frame? What's your personal ability to tolerate volatility through that period? And we can recommend an option so that when these market conditions happen, you're comfortable because you're prepared for it. So it doesn't have to be such a frightening thing for people.
Yeah, I think that's right, Dan. And if there's something that I would like members to hear and hopefully resonates with them, is that they can have confidence in the investment strategy that we operate. So we are highly active investors. We can adapt to market conditions and take advantage of opportunities. A centerpiece of our investment strategy, it's not just smoothing out the bumps and the bruises in markets, but it's also about being highly diversified. We've got teams of professionals across all asset classes, really interesting, fantastic investments, private equity, infrastructure, credit, and building a really diversified portfolio that has that resilience is the thing that should give our members confidence that their nest egg and their retirement savings are in safe hands, and then they're more able to navigate the events that happen in the world and be able to stick to their investment strategy.
We are reacting to live questions. Thank you. So I'm going to throw to you, Dan, now. We've had a couple of questions come through, and I think this is a really good one. We've got people online who have already retired, maybe recently, and we've got a few that are coming through. And they want to get a better understanding of, we've talked about, yes, it's all okay to draw your income and it will recover. You've said lump sums, have a think about it, because if it is something that you could delay, maybe it is good to get past some of this volatility. The problem is we just don't know how long that might be. So again, retirement should be about your own personal choice, and coming to chat to somebody about what the trade-off in that choice might be is a really important thing. But the question specifically is, should people be adjusting their drawdowns? So you do have choice about how much you draw down. Would you be taking the minimum now? Do you just keep going as you are?
Yeah, I mean, the sequencing risk thing, we talked about it from the perspective of lump sums, but it's the same thing for drawing income as well, because you're still actively drawing funds down in a point where potentially the assets are a little bit lower. But I mean, people have living expenses. You still have costs of living. So That's such an individual question that I'd suggest speaking to one of our team and we can talk them through that individually. But I mean, some people will choose to reduce their spending in times like this so that they're not drawing at a lower point. Maybe you'd plan to do a holiday. That was built into your budget. Maybe you can save that till next year. Things like that. What things can you reduce now while cost of living is expensive and while your assets might be slightly reduced? There are ways to avoid it, but we've got to individually look at it.
I think that's a really important point. And sorry, we keep asking with, it's individual and please come and talk to somebody, but that's really at the heart of it, because everybody has choice. So I want to give everybody the comfort that you do have choices. You are in the driver's seat of this, even while markets just do what they do. And I think the gold part of it is actually coming and talking through what those choices are for you.
Yeah.
And it does come down to markets will continue to do what markets do, but you need to think about what is important in my life right now. Am I able to, or am I not able to, whether it's reduce living expenses or defer holidays? There might be people online right now that actually don't have a choice in the expenses that they've got coming over the bow. So please, that's what we're here for. Yes, we're here to invest the money and make sure that you get a smooth ride out of this, but the other part of it is that we're here to help, and we've got people who know how to navigate this system and make sure not only that your income lasts, because that's the main game, is giving people an income, but also other things like, are you maxing out other benefits like Centrelink, and what other choices do you have in the mix now to make sure that you get the best possible retirement outcome? Excellent. Dan, any other thoughts that you would give to?
I was just going to say that, retirement planning, we've talked about some of the concepts, but there's a lot that can go into structuring a retirement plan to make sure that so that we can reduce volatility and so that we can secure a longer term income. I would suggest that you don't need to do this on your own. We're here to invest your money, but we're also here to make sure you're getting the maximum benefits from it. So please reach out to us. We'd love to talk to you, and we'll make sure what you're doing is the best thing for you.
Yeah, that's awesome. Okay, we've got another question that's come in, which is a really good one. Suzanne, this one is for you. And we have a very opportunistic member base. I love this. But, if you sort of try and get out of the doom and gloom of now,
yes,
where are the opportunities that you see in the next sort of 5 or 10 years? Where are you feeling positive?
Yeah, I think there are a lot of areas. We've come through a 3-year period until quite recently where share markets were so strong. So for the 3 years to June 25, each of those years, global shares rose 20% in each year. Now that's extraordinary growth, and I think that that members sometimes can think that that's normal. That's actually not normal for shares to go up that much for so long. That's been great environment for share investors and for our diversified options that have portions of the investments in shares. Some other asset classes have done well as well, but nothing to rival the share market returns that we've seen. Now that has slowed recently, and in a world where growth is okay, but inflation is a bit higher, government debt is also a bit high, and potentially the ability to reduce interest rates might be a bit more constrained in the next few years. It probably suggests that some other asset classes might come to the fore. It might not just be the domination of shares anymore. We've got a very strong private equity program. We really like real assets. We think infrastructure outlook is quite good. Very diversified credit exposures, which are really value adding. But we've got a great alternatives program as well. At the moment, our alternatives, absolute return, thematic opportunities, some really interesting investments that are doing better than traditional fixed income, and even some of our other mid-risk assets. So I think we're coming into an era in the next couple of years where diversification will actually be beneficial, and having investments across multiple asset classes will really help. I would encourage members to make sure that when they go into their account to understand what they're invested in. There's a lot of information on our website. If you're invested in the balanced option, have a look what's in it. Have a look at all the different asset classes, the diversification. Each one of those asset classes gives us a wealth of opportunity to deliver higher returns and also to control risk and reduce risk. So I think that there are fantastic opportunities across a range of different asset classes. I'm not so sure that very strong leadership is going to come from shares all of the time as it has recently, but we're not expecting, a universally poor environment for shares at all. I think it's just going to be a little bit more selective in the next couple of years. But yeah, members should have a look at what they're invested in, even if it's something like conservative balanced or capital stable. They'll be able to see that there's a wealth of different asset classes and diversity in there, and it's good for them to understand that. And that sometimes can be a trigger for them to talk to someone in Dan's team or for Dan to say, okay, do I understand what I'm invested in? Because understanding that often is where the confidence comes from. It's like, all right, I know what my superannuation is invested in. I know what my retirement relies on. I understand it. I'm good with that. And I think that there's a lot of strength that can come from that knowledge.
Yeah, interesting. Someone's just picked up on something really interesting because you've talked about risk a couple of times, managing risk and thinking about risk. And I think that's really, really important in this because it is, potentially unique to the way we look at the markets versus others, right? Can you sort of talk about we've used it as a general term. What does that actually mean in practice? What are we doing to manage risk?
Yeah, okay. What it means in practice is that when share markets are quite expensive and have gone up a lot, we're unlikely to have more invested in shares in the diversified options than other funds. In actual fact, we'll probably have a bit less. We'll be more thinking that overvaluation potentially poses risk. We're more likely to have higher allocations to a broader range of different asset classes that perform differently at different points in time. And that's where you get that diversification from. The whole point of diversification is that you've got a multitude of different things that are doing that behave differently in different market conditions. It's the old-fashioned don't put all your eggs in one basket concept, okay? You're not reliant on one thing just doing well. The other key pillar, other than diversification, of how we do that risk control is we're very active investors. So passive investing, which is just investing in line with an index, can do really well sometimes. And there have been a year or two in the last couple of years where passive has done really well. We are believers in strong active management because investing in an index means that you're investing in everything that's listed, for example, on a stock market. Whether it's a good or a bad investment, whether it's going up or down, you just follow the index. We think it's intuitively better and has been shown practically better to be much more selective. Being active means that you can not only allocate more for members into investments that have got a great outlook, but you can also move away from investments that look like they're going to be poor performers or are very risky. So active management and diversification is really the centerpiece of what we're doing and how we're executing that strategy.
Wonderful. Now, a few people have picked up on our friend Warren Buffett in the chat, which is that's fair. And look, there has been reports that, someone like Warren has gone to cash, right? And that has actually been reported. Whether it's true or not, I can't report that here because obviously we haven't verified that. But it is pretty safe to say that Warren Buffett is someone who does take big bets. And he's betting in a certain way. But I guess, the question in that is, is Care doing something similar? Or you really may have answered it because it is about diversification over big bets.
I think I have kind of answered it, Kat. But in actual fact, one of them, I was going to say the most famous, but you probably picked the most famous one. But probably other key most famous quote is around the rules of investing, which is rule number 1, don't lose money. Rule number 2, don't forget rule number 1, right? And that is at the heart of the smooth ride and what we are doing for members. It is all very well to have the highest number on the page when share markets are going up and it all looks easy, but that is not what Strength in Retirement is about. Strength in Retirement is about resilience and strong long-term outcomes. And having in mind to both the opportunities and the growth, as well as when things don't look so easy, that's really the key to success, I think.
Yeah, and I think you've really summed it up nicely because at the end of the day, whilst we are talking about investments, the reason why you're a member of Care, whilst there are options that allow you to take a little bit more control and choose those things yourself, or you can be selective, you are trusting an investment team to actually make sure that they're thinking about this and obsessing on it day in, day out, and we have a wonderful team that are doing that. Our job, our primary job for you is to make sure that once you reach retirement, that you have a balance that you can then rely on for income, and it becomes essentially like your paycheck in retirement. So we make sure that we're investing well, and that when you need it, and if you're feeling uncertain or you want to make some choices, whether it's, by all means, some people online are feeling really opportunistic versus some people who are feeling nervous, we have the people that can actually help you through those choices and make sure that you are making the right choice for yourself and your circumstances. So with that, I want to say a very big thank you to Suzanne and to Dan. I want to say a very big thank you to everybody who joined us online. Please know that we've captured a lot of the questions. There was a lot coming through, as you could possibly imagine. We will do our best to sort of theme those up and make sure that we answer as many as possible. Again, if you've asked a personal question, we will make sure that we get someone to come back to you on that. We weren't going to answer any personal questions online. And then finally, if you would like to book in to see someone, you're always welcome to call the call centre, or there'll be a link in the survey that we send out afterwards to make sure that you can book a call back. So again, thank you for joining us over lunch. Thank you, Dan. Thank you, Suzanne. We'll see you next time.